In this episode, I'm going to walk you through on how to put a value on a SaaS and software deal. In this episode, I'm going to dig deep on how to put a value on a software and SaaS deals. By the end of this episode, I'm going to walk you through how exactly put a value on a SaaS or software company and what a strategy to follow to find the purchase price for a SaaS or software company. Intro. Everybody, welcome to my channel. In this channel, I'm gonna help you to be a better investor with an invincible energy. I'm excited about today's episode because it's an important topic, and you know, a lot of people, they have a software company or they want to have a software or SaaS company, but exactly they don't know how to value it. So today I'm gonna show and demonstrate how to put a value on a SaaS or software as a service investment deal. And to be clear, it's not about any investment deal for any SaaS company or VC or VC type or a startup company. It's exactly for cash flow software deals that they have historic financials. So buckle up for some serious insight. If you're new to this channel, welcome. I drop an episode every Sunday with actionable strategy and tactics on how to be an investor, find, acquire, and run your cash flow SaaS company. Be sure to hit the subscribe button and the bell icon. That way you get a notification every time I drop a new episode with Sam's energy. If you're part of this community, my people, welcome back. It's really awesome to see you over here. So if you're excited to dig in, go ahead and smash that like button for the YouTube algorithm. YouTube loves it when you do that. Let's dig right into it. So how do you value a software company? Now, this is very near and dear to us because we own a portfolio of SaaS companies. We've really seen a lot of different effects and the market trends and up and down in the SaaS world. And the growth that can affect the value, but more importantly, the operation. So we manage, own, and operate our own SaaS companies. So the valuation to us is a bit different. We look at it differently than a buyer that wants to buy an asset and runs it by himself without a team. Because what we do, it will affect the valuation of the company, will affect the value in the value creation. So if you're looking to buy, the question is how do you value it? Do you do the add backs for the CEO and the founder? Or do you go based on the EBITDA of the company after deducting the CEO salary? And then whatever left, it's the actual EBITDA. Well, these are good starting points. Generally speaking, there are two ways that people look at the value. One is based on the STE for smaller deals, or they are looking at the EBITDA for much larger deals. So to figure out the cash flow and figure out how to put a purchase price on a SaaS company, you have to put the financials for the past 3 years, including the TTM, the last 12 months, and year to date. And then from there, you have the revenue, you have the profit, and you have the expense. And after that, the net income comes through. And as you can see, for example, 10 to 15% increase year over year, 2.8, 3.2, 3.6, and $4 million of net income. And then there is some sort of add backs. If there is any add backs that can be, car lease or anything that's related and it makes sense. And then after that, you can figure out what's the actual EBITDA. And that's how you can put a purchase price on the company and see how much debt you can put in this and what's the compound annual growth rate to put a value for the future. But at the end of the day, you have to look at the EBITDA, you have to look at the adjusted EBITDA and see what are the historic financials. So if here is 1 year 2.5, 2.8, the next year is 500,000, the next year is 3.6, there is something wrong. And maybe it can be a working capital issue. So you have to dig deep in. But the best case scenario is the EBITDA growth year over year. It can be 5, 10%, 15%. The revenue, whether it goes up and down, creates the actual value. Because the value of your software company to you is simply how much money you're getting back, right? It's how much that asset is returning money to you. What are your capital returns? Now, this can be very, very tricky. And one of the reason that is tricky is because most people underlying assumption of what is a good value, of what is a good deal, changes so much. And it depends on what kind of value you can add to the asset moving forward. So it's not solely dependent on what is the enterprise value, but what value you can add. If you're starting to see the power in this, can I get a yes in the comment below? And also smash that like button for the YouTube algorithm. YouTube loves it when you do that. So what are the capital returns? And this one is tricky too. So what are the capital returns? It depends again because the underlying assumptions people from the capital return changes. And what is a good deal changes and different for everybody. Maybe somebody can return 25% on their money and that for a SaaS company can be a good deal. But I wouldn't accept anything under 30% cash on cash return. And that's not an IRR, which is an internal rate of return. And the IRR, it's funny, it can be manipulated because that can be an assumption for the future. That, oh, maybe I can sell this asset in 5 years for $10 million. And then my internal rate of return, the IRR, can be huge. Well, if that plays out like the way that you plan for, in whatever time frame, it's the same that it's how I look at it as well. I look at the cash flow basis year over year, how much money I can make every year, how much money I'm gonna make, how much money do I have to put in, and what's the risk associated with this asset. Value has actually two things. One, which is how much money do you make, and how's the market is going to be, and what's the past historic financials. All of those needs to be factored into the decision. And then what are the markets? Like how can a market put a value or create a value for a specific SaaS company? And usually for EU and an Asian market, the valuation is not as high as US market. And when we are looking at it though, I don't care about any of these elements. What is important, what I'm looking for is the revenue and how much can I affect the revenue moving forward. And if the business is underperforming, I would be happy to go to the market and buy an asset for 5x multiplier on EBITDA. With the revenue that has been mismanaged, it can be a lot of upside potential. Maybe I can increase the revenue by doing a value add, and with that I can change some of the revenue drivers and increase the revenue and be more efficient on the expenses and really drive my income, which will increase my year-to-year cash flow. And that's how we find the value. We look at the business operation and make sure the value add is effective and it makes sense for the company. And that can be in a lot of different ways. And in a SaaS company, you can do a lot of different strategies, like upsell and cross-sell with the current product that you're offering. And you can bundle, or you can, as I said, use upsell and cross-sell to increase the LTV, lifetime value of the customer, and a lot more other ways that I will share in the future episodes. And this is how we really leverage the revenue through SaaS company. So exactly how we find the value and how should you think about it. And that's how we should look at it. To figure out exactly how to value a software company, it's not that much about EBITDA or SDE. Looking at it as, if I buy this company, what can I do with it to increase the revenue? And how can I drive the revenue up? But for the purchase price, you need to keep in mind that the historic financial are important for a cash flow software company. And figuring out the past compound annual growth rate and get a dip based on the historic financials. But at the end of the day, it's all about the product, market, and go-to-market strategy for a SaaS company. But this valuation, as I said, it's only for cash flow software companies with historic financials, and these companies are different than VC eligible. And these companies are private equity eligible. They don't apply to a VC model. And the founders, they don't want to raise money to get diluted. But when do you know that your company is not eligible for venture capital or VC? For the private equity model, these values needs to be considered. So for example, anything that the growth has less than 2x and the gross margin is less than 20%, net dollar retention is less than 100%, CAC payback, customer acquisition, payback is over 24 months, or if the burn multiple is over 2, then your company is not VC eligible. And also, if your annual growth year over year is less than 15%, this is not VC eligible. And the best way to go about it is go and get acquired with a private equity company, because it's hard to raise money. And if you cannot raise money and you run out of cash, the founders, they don't get any money. The founders at the end of 5 to 10 years journey, they get zero money. They get zero return. And that's not the optimal return after working hard for 10 years. But if you go to a private equity route, there is a lot more option. For example, for a $10 million company with, $4 or $5 million of EBITDA, the return can be a lot more than if you're going and keep continuing with the VC route. And that wraps up our deep dive into finding value of a SaaS company. And remember, the value of the company is different than EV or the purchase price. Calculating purchase price is based on the historic financials of the company for the past 3, 4, 5, 6, 10 years. But finding value is figuring out how I can increase the revenue moving forward within 3 to 7 years, 10 years from now. Also, if you got a value from this video, smash that like button for the YouTube algorithm. YouTube loves it when you do that. I put a lot of work into these videos to make sure you get a value. If you know or have a fellow investor or a SaaS founder, if you're part of a WhatsApp or a Slack group of other investors and founders that would get value from this video, please share this with them. That means the world to us. Also, I drop an episode every single Sunday with actionable strategy and tactics, with working one-on-one with investors like you, and also operating my own SaaS companies. So be sure to hit that subscribe button and the bell icon, and you'll get notified every single time I drop a new episode. And lastly, remember, stay strategic, stay informed, and happy investing. I'm Sam, and I will see you in the next episode. Take care, everybody. Got it. So basically, it's a deal between 2 to 15 million EV would be 1%.
So north of like 5, 6, 7 million, 1% is probably too much. Down closer to 2 million, 1% is probably not enough. If we're thinking about it on an hourly basis. So, in that like 3 to 5 to $7 million range, you're probably somewhere around 1%. And then outside of that, obviously we'll look very closely at the scope of work. Legal counsel, because legal counsel in our space is typically one of two things. It's either really bad M&A counsel that doesn't even know M&A and they're just taking the deal to take the deal. Or it's a mid-market, M&A attorney at a mid-sized shop that's built for a $50, $100 million deal. They bill by the hour, so they want to grind the fuck out of the deal, excuse my language. Sam, do you have a current deal under LOI, or where are you at?
So right now I'm working on a deal. It's about, it's a mess. I mean, the seller, the recurring revenue is low, and then the one-time revenue is really high, and the revenue 2 or 3 years ago was 14 million. Now it's $10 million. So it's been declined, and the EBITDA is low, and and the seller wants $3 million, and yeah, it's been a long couple weeks. I think more than couple weeks now. We haven't finalized on it, and I'm still waiting from the broker, and even I told the seller, if we can change it to a stock, you can stay and run the company. All the time we try to find a good deal, but the issue is either the price are too high that they're asking too much, and then if we pay too much, then we cannot return any money to our investors. So, or the deal has some sort of problem, some sort of issue.